recording it now. Please read profitability ratio. पढ़ लीजिए. अच्छा, उसका पहले है we were studying about debt equity ratio. वो किधर आता है?
So
Debt
solvency.
इधर में आएगा ना क्या?
So debt equity ratio, solvency ratio is not.
Solvency ratio. हाँ, here it is. Debt equity ratio. इसको पढ़ लीजिए. It expresses
It expresses the level of long-term debt in proportion to the equity, that is net worth. Debt equity ratio is total long-term debt divided by shareholders' funds. Shareholders' funds include paid-up capital plus reserves and surplus. Its interpretation is the ratio indicates the extent to which the unit depends on outside funds to finance its long-term requirements. Lower ratio indicates the firm is solvent in long term. Lower the ratio is better.
आपने क्या बताया हमको? आंसर क्या बोला आपने? आइडियल रेशियो.
मैंने 2:1 बोला था.
That is गलत है.
Yes.
1 is 1/2.
Okay.
It should be 1/2. Lower the ratio, the better it is. Okay.
Okay, sir.
Yeah. Now, Nigarika, I suggest you read profitability ratios. पढ़ लीजिए. Return on investment.
Overall profitability ratio, it indicates the percentage returns on the capital employed in the business. Return on investment is operating profit divided by capital employed. Capital employed is the sum total of long-term funds employed in business, that is share capital plus reserves and surplus plus long-term loans minus non-business assets plus fictitious assets. Operating profit means profit before interest, only interest on long-term borrowings. Non-operating income and taxes. Its interpretation is ROI, return on investment, is the measure of profit on investment of a unit of capital, profit being the net result of all operation. This ratio is used for measuring overall efficiency of a business. The ratio also indicates whether the company or firm's borrowing policy is economical and whether the capital employed is fruitful. Ideally, the return on investment should be more than the cost of long-term funds, interest on long-term borrowings, and opportunity cost of capital. For the survival of business and to be economical, higher the ratio is better.
Operating
Earnings
profit,
per share.
higher the ratio, it is better. So at least
Yes.
2:1, 3:1, when I say it is better. Very good. Continue. Earnings per share.
This ratio helps in determining the market price of the equity share of the company. Earnings per share, net profit after tax and dividend on preference shares divided by number of equity shares. Interpretation, comparing EPS of a company with another help in determining the market price of the equity share of the company and help in deciding whether the equity share capital is being effectively used or not. It also helps in determining the company's capacity to pay dividend to its equity shareholders. Higher the ratio is better.
Higher the ratio, it is better. That is net profit after tax and dividend on preference shares divided by number of equity shares. That is per share के लिए कितना earning होता है. Higher होने से better है. Continue.
Yes. Price earnings ratio, PE ratio. This ratio indicates the market value of a share in comparison to the earnings of the share. PE ratio, market price per equity share divided by earnings per share. Interpretation, it is an indicator to know whether the share price of a particular share is costly or cheap, and it helps the investor to decide to buy or not to buy a share in particular market price. Lower the ratio is better for investors.
If it is lower, it is good. Continue. Gross profit ratio.
It expresses the relationship between gross profit and net sales. Its formula is gross profit ratio is equal to gross profit divided by net sales into 100. Its interpretation, this ratio indicates the percentage of gross profit margin of the unit. This ratio also indicates the degree to which the firm can reduce the selling price per unit of goods to remain competitive in the market without incurring loss from operation. The gross profit ratio should be adequate to cover operating expenses and to provide for fixed charges, dividends, and for building up reserves. Higher the ratio is better.
Higher the ratio, it is better. Net profit ratio.
It expresses the net margin on sales and indicates the efficiency of the business. Net profit ratio is equals to net profit divided by net sales into 100. Interpretation: over a period, increasing in net profit ratio, keeping the gross profit ratio constant indicates improvement in operational efficiency. This ratio is an indicator of profitability. Higher the ratio is better.
Good. Very good. Next is, who is there next?
Solvency ratio.
Ankur. Mr. Ankur.
Yes, sir.
Yeah. Please read. Ankur, what is your degree qualification?
Sir, MBA Finance as a major and marketing as minor.
It's excellent. Excellent. I think even Niharika MBA, na?
Yes, sir.
Niharika also MBA. What about the other person who is there online? Ritu Parna. You are also MBA?
Yes, sir. Yes, sir,
Acha,
I
acha.
am also MBA.
Is it that they have prescribed minimum MBA as qualification or MCOM as qualification? In
Sir,
the
No,
MBA
sir,
PF,
is
only
minimum.
MBA
MBA,
Finance and CA.
MBA Finance?
And
And
CA
CA,
candidate
CS.
can
Oh,
apply.
very good. Very good. Or CA can be there. Very nice. So that is why there is no problem about it. So good. So all of you are supposed to know these things very well. Ankur, आप पढ़ लीजिए. Solvency ratio.
Okay, sir. Solvency ratios. A business entity is said to be solvent if it is able to meet all long-term and short-term financial obligations without any strain. Long-term solvency ratios, then fixed asset ratios. It expresses the level of fixed assets in proportion to the long-term funds. Fixed asset ratio is equal to fixed asset divided by long-term funds. And fixed assets includes net block and other non-current assets such as investment. Long-term funds includes capital, reserve, and long-term loans. Interpretation.
Yes. The ratio.
The ratio should not be more than 1.0, because if the ratio is more than 1.0, it indicates that the company has created more fixed assets or investments by diverting short-term funds and may create liquidity crisis. The
Hmm.
ratio of less than 1.0 indicates that part of working capital has been funded through long-term funds. Ideal fixed asset ratio is 0.67. Lower the ratio is better from liquidity point of view, but much lower ratio indicates that the unit is conservative for investment and future expansion.
Yeah.
Then
Is
debt
it
equity
clear?
ratio.
Is it clear, Ankur? आपको clear है? This one?
Yes, sir. The thing is,
Can you tell me
it is,
about fixed asset ratio?
sir, I have one question.
Yeah.
Can you please show that just what I just read?
Yeah.
Sir, here it is mentioned ideal fixed asset ratio is 0.67.
Hmm.
And above there the ratio is less than 1.0. So 1.0 is what like line, like below which it is good, and above which is not good, kind of that.
No, no. The ratio should not be more than 1. If it is
Okay.
going to be more than 1, इसका मतलब ये है, you are having fixed assets of 125 crores. Your long-term fund is only 100 crore. So then what happens? The 25 crore you have taken from short-term funds, which will indicate that you will be having problem in meeting your day-to-day expenses. It indicates that the company has created more fixed assets by diverting short-term fund, and this will create liquidity crisis. Matlab, whatever immediate payments to be made, the company will not be able to meet its liability because you have already taken from short-term funds. The ratio of less than 1 indicates that a part of the working capital has been funded through long-term funds. If it is going to be less than 1, इसका मतलब ये है part of the working capital has been funded through long-term funds. Ideal fixed ratio is 0.67. Lower the ratio is better from liquidity point of view, because liquidity point of view, it is better because you are having not only short-term funds, but also long-term funds available for making payment of present day crisis. The ideal ratio, they say it is 0.67. My view, if it is 1:1, that is good. But aisa to kabhi it won't be possible for companies to have it exactly 1:1. That is, what does it mean? You are getting some long-term borrowing, that is term loan. You are using it for buying machinery, first class. But you are buying a machinery, but you are taking only 50% of the loan from the bank. Balance 50% you are providing from your capital, means okay. But if you are going to bring from your working capital, then that will affect the liquidity crisis. Yes, Ankur, what is your doubt?
This only about the what you said, that ratio, ideal ratio.
Ideal ratio is, in my view, it is 1:1. But then when it is brought down, it shows a part of it has been taken from the short-term capital, short-term funds. But that is okay, but it should not be too much. Too much borrowal should not be done from the short-term funds. That is the point. But ASAP, yeah. So the question will be asked like this. Please tell about some ratios you are familiar with. This is the favorite question they ask. In which case, most of us will talk about current ratio. So you can choose this one, that is profitability ratio. Then this fixed asset ratio, then current ratio. Like that, you can talk on any one of these things about which you are more confident. And debt equity ratio also. Okay. Now, sometimes they will ask you, tell about debt equity ratio. In fact, I don't know whether I have Bank of India questions. For you, what will be more suitable is the latest Bank of India credit officer interview questions. That is what is more suitable for you. Let me see whether I'm having it here. Maybe it is there in the sheet I have produced also. Central Bank of India Scale 3, South Indian Bank, Federal Bank. Yeah. Or sometimes I used to put it as boy. 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 No, it is not coming here. Here itself, I'm not sure whether it is available here itself. In the paper I have given you, are there questions on Bank of India level? Simple questions. See, this is how they are. Are you seeing on the screen now? Balance sheet. Are you seeing it now on the screen? I will show you.
Yes, sir.
This will be your interview. Balance sheet items and its analysis, ratios, types of credit facilities and bank offers, Differentiate between term loan, cash credit, overdraft. What will you analyze while giving loan for working capital? What is current assets minus current liabilities? Like this. This is your question. Baba, here. I am getting here. Bank of India credit officer. GD topic was new education policy. Introduce about yourself, family background, graduation, why not done in the career in engineering, why you want join bank, is banking easy, then balance sheet, situation about granting loan and informing people about the scheme, difference between data and information. Maybe this is a computer boy. Next question, tell me about yourself, father's occupation, role of the credit officer, why do you want to join boy, what are your strengths, economics related, about G20, who is your role model. That's all. They don't ask very tough questions at all. They will ask very simple questions only. So we will continue with this. Are you now seeing this? Yeah. Ankur, please continue with this.
Okay.
Debt equity ratio.
Debt equity ratio, it expresses the level of long-term debt in proportion to the equity, that is net worth. Debt equity ratio is equal to total long-term debt divided by shareholders fund. Shareholders funds include paid up capital plus reserve and surplus. Interpretation, the ratio indicates the extent to which the unit depends on outside funds to finance its long-term requirements. Lower ratio indicates the firm is solvent in long term. Lower the ratio is better.
Are you able to follow this? Could you follow, Ankur?
Hello.
Are you able to follow?
Sorry, sir. I just received a call, so that's why I didn't hear. Yes, sir.
Please read again. Debt equity ratio.
Okay. Debt equity ratio. It expresses the level of long-term debt in proportion to the equity, that is net worth. Debt equity ratio is equal to total long-term debt divided by shareholder funds. And shareholder funds include paid up capital plus reserve and surplus. Interpretation. The ratio indicates the extent to which the unit depends on outside funds to finance its long-term requirements. Lower ratio indicates the firm is solvent in long term. Lower the ratio is better.
Yeah, good. So I will stop this with